Okay, so any questions from the previous session?
I don't know if this is something that you're planning to cover later. But I was wondering, like for example, when you said your usual risk amount, it's a 0.25. I was wondering, is it like the maximum scaled in or your initial position risk? Like, is that how you define it?
Yeah, that's a good point. Just 1 second, please. Okay, so it depends really on the situation. For example, if you're going into a trade knowing that you have better odds if you are scaling in, then the position size for that very first entry is going to be even smaller.
Okay. Okay.
And also depends on your entire strategy. For example, are you going to allow yourself to scale in or not? So
Right.
it's partly also how you structure your trading in general, like, am I going to be scaling in or not? And then if you're allowing yourself to be scaling in, then you have to make one more decision on every setup. Is this setup going to be one that you scale in or not? You have to make that decision beforehand, before you start trading.
So if we are planning to scale in, then
Mhm.
we should enter the position in such a way that our maximum scale in position would be our maximum risk percentage we are planning to do it. So it will be 0.25 after scale in position.
Yeah, exactly. But what ends up happening is that it's never exact. For example, let me show you on this chart. This is not up to date. This is the 8th. This is the chart I used to update the page on the upcoming workshop. That's why the date is here, because this is the date that Al was using for his chart and I was using the same chart. So this is that chart. But anyway, let's say I'm buying here. So there's a buy setup, but bear micro channel with open gaps. So even if it goes up here, it's probably going to come down and then go. So let's say I buy one entry here with the intention of scaling in. And I'm looking to the left-hand side. I know where bears got trapped. Bears got trapped selling above 6 high, right there. Okay, so that's the second scaling entry. It makes sense because this is a trading range day, and there was an expectation for a second leg proportionate to these bars. So the market should have came right down here, somewhere here. But it didn't. So it did the low probability thing here on these 3 bars. The fast bears, they were able to scalp. So they sold up here and they saw this bar. This was their entry bar. They got trapped on this bar. And then they decided to exit here. It was actually a minimum scalp because this bar is more than 5 points. So had you sold the high of this bar, you could have had a 5-point scalp on bar 8. But if they were looking for a second leg proportionate to this coming down here, which was very reasonable, right? So if at least the bodies of these bars from here to here, so the expectation was either, I'm selling here, this would be my second leg, or selling above the high of this bear bar, this would be the second leg, or selling from the moving average, this would be the second leg. So somewhere between this red line and this gray line here in this area, that was the expectation for the second leg of this bear breakout. But breakouts on the open have lower probability of success because of the nature of the day. So the market first is going in the wrong direction to find support and then bounce from it. Anyway, what they did was reasonable. So that forms a layer of support here at the high of this bar, which I'm looking at and I'm thinking that, okay, if I buy here, the market can easily test that line. Actually, it did. Let me put it on the high. So that's exact now. So it fell 1 tick below. So buy here, that's the scaling. It's a dangerous scaling, right? It's against what Al is teaching. Al says, wait for another bull bar and buy the close or the high or above it. Well, you have to buy here in that case, which is not better than your first entry. So this scaling at this point doesn't make sense. But if you see all of this and you know that day is a trading range day with, 1, 2, 3, you can say implied 4, 5 legs down. It makes sense to buy here with limit order. But if you do that, then you really have to adhere to your stop. If your stop is here, wherever you put it, okay? If you buy aggressively, you have to be a very disciplined trader. Anyway, that would be the second entry. Now, let's say I had my limit order lower, like below bar 9, and I didn't get filled in here. So what happens next is, all right, so I either have to take this off at break even, or if I'm optimistic that the market is going to close the gaps because this started with a bull bar, so there's a magnet there. So it's probably going to get there. And this would be the prospect for the trade. On a trading range day with this very strong move up, expecting the market to retrace at least half of this is reasonable. Then I have to look at what are my other options to scaling. Well, the other one is here's a micro channel. Buy here when the market is testing the high of this bar. This is equal to somebody selling here and expecting the market to go down, but instead the market goes up. Usually this location is tested again, but this took half the day to get there. But usually you get the test on, 3, 4 bars later. So this is equal to this situation. That's another limit order scaling entry right there, that line.
Ali, can I ask you a quick question?
Yes, please.
Would the time of day affect your thinking at this point too, given that it's right around bar 40, or not a factor?
Yeah, that's exactly. So wedges around bar 40 around 1 p.m. on a trading range day with a breakout to a new high of the day. That is also important, but this structure is also complete, right? So you have 3 or 4 or 5 legs down. It's with good buy signal bars and bad follow through for the bears. It's reasonable to assume that all of this was a test of this point where bears got trapped, and now we're going to put in at least 2 more legs up. So buying here, all okay. Trading range days, you have to be very flexible with your entries because the market doesn't do things like the trend days. Sometimes the bars are very big and out of the blue. I don't know if you have noticed it or not, but having been in Al's room for almost 10 years now, I've seen him buy or sell, enter a trade expecting surprise bars on these types of days. He doesn't typically talk about it, but how I noticed it was his exits. So he would exit a trade and just comment right after that, it didn't do what I expected it to do. And his expectation is bars like this, like, you buy like a doji, for instance, this bar, and the day is a trading range day, you expect the next bar to be large. And if it doesn't become the size that you are expecting it, then that's a kind of disappointment and exit because of that.
Ali, you're talking about the moments where he'll talk about like selling below a double bottom and giving it a few seconds to break sharply to the downside before he exits.
Any kind of entry, Brad. Any kind of entry that you expect a sudden and big move based on the price structure. Like if you look at these trading range days, the second bar is usually crazy, right? So doji, like here, big second bar, bad entry bar, big move from these bad entries. That's how the trading range day behaves. small doji here, tail on top, failed breakout, but suddenly big bar. So, I mean, that is the expectation when you're trading in a trading range day. And you should be expecting those bars because normally that's what happens. You have bars that do not look all that great, like this one, and then the second bar is large.
One more quick question about the weak levels, or not the trap, the levels that you've marked where there are trapped sellers and buyers up there. The buy, the target for the buy, and then the pullback target for that second entry limit order. As the day is developing, I mean, so after watching last week's session a number of times during the week, as the day goes on, I started marking those levels, and I was wondering if that was part of your workflow as the as you're trading, if you're marking weak levels where people entered on reasonable bars and got trapped, or if it's something that you just eyeball as the day goes on.
Depends on how discretionary are you. So it's some traders just do it beforehand and just look at those, and some are able to see it while it's happening. Over the years, it changes. For example, years ago, I used to spend a lot of hours preparing my chart for tomorrow. Right now, it is less of that. I just show up like 10 minutes early and then look at the prior day's chart. Sometimes I don't even mark the lines anymore because I just know what happened the day before. So it depends really on how much mental capacity you have developed to not think actively and just remember things.
Sorry, I meant more in terms of like during the current session. So like as the 8th is trading, and we get this move down, and we get the move down on the open. Would you mark those trapped sellers at bar 8?
No, I'm very lazy during trading.
Okay.
I just don't do much. One of the things I actually do is this. So one of the trades I like to do is this. So mark the channel line, trend line of a channel, and then buy with limit orders below a strong bar when the market penetrates this line for the first time. That's a limit order entry I like to do. So for these, sometimes I draw the line because I want to be precise, and this helps to be precise. Here's another one. These lines. And it's usually the best fit line. It's not according to technical analysis recommendations that you take the first two and then draw the line. I just look at it and what makes more sense, that's the line. And then start buying. This is good. So this is another buy and scale in. So the buy is not at the line because this is so tight. The buy is below the low of a bull bar, this bull bar, this bull bar. And then you look back to see what happened. So there was a limit short at the high of this bar. High, okay. There was a limit order short here. They couldn't scalp here. This didn't give bears enough profits in terms of points. So this becomes support. So if I buy here, that's the next entry for a scaling. Where is the stop? You hide it below these prior swing points. So whenever there is a trading range day, and this is one, every time that you see two parallel support and resistance lines, odds are the market is not going to penetrate both. This was the prior one. So there are two layers of support here. And if the market falls below this high, it shouldn't fall below this high, which means if I put my stop just below that red line or, 4 points lower, something like that, about here, it should be well protected from price action because buyers here, buyers at the moving average, buyers here. So if my stop is here, the market should have done something extraordinary to get to it, like something like this, right? And in that case, I know that the discussion a couple of weeks ago that if your stop gets hit, it's usually because the market is going to delay that trade. So, okay, take a loss here, but then I probably have chances for two more short trades going down. Same thing that happened here. Surprise, 2 more legs up. Yeah, so that's the, sorry, long answer to a simple question, but that's how price action trading typically is.